And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Options trading has exploded in the last few years, and recently a particular type of options trading has become popular, and the ETF industry is sitting up and taking notice. 0 days to expiration options are options contracts that expire and become void the same day that they're traded. Sophisticated retail traders are using them to make a one-day bet on the direction of the markets. The heavy flows have attracted the interest of the ETF industry, which is looking to launch new options products around these soon. Now, do these products pose any risk to the stability of the underlying stock market or to markets in general? Let's talk with Ed Tilley. He's the chairman and CEO of SIBO Global Markets. Michael Green is the Simplified chief strategist. Ed, good to see you. These 0 days to expiration options, they're typically S&P 500 options. They have monthly or weekly options that are principally traded on the final day of the contract. Those of you who don't know that. So explain to us what's going on here. Why have they suddenly caught on with the investing community?
Thanks, Bob. Really what's caught on is the ability for investors where they're most certain, and that is the shortest duration of time left in a contract. Much more comfortable predicting and having an opinion on the market in the short term than, let's say, 1 week, 3 weeks, or even a year. So it's really become attractive and garnered a lot of interest in being able to express that opinion in the short term. And then the other characteristic, primarily when we're trading SPX options, is they're cash settled. That means at the end of the trading day, the net result of that trade is settled in cash, not physically delivered like a stock or an ETF.
You know, Michael, let me bring you in. I'm an amateur behavioral economist, and there's a number of things here that are obviously very easy to explain in terms of why this kind of trading is popular with retail traders. So I want to use an example of how a retail trader might use these and get your comment on them. So, and for those of you who don't know, this is an example. Suppose you think the S&P is going to go up on that day. So you could open a position and sell an S&P 500 put, which would be a bullish call. You'd collect a premium, say $1. So if you're right and the S&P closes up, the put expires worthless. And because, as Ed said, it's a cash settlement, you get $1. As a retail trader, I can easily make, Mike, a one-day bet on whether I think the S&P is going to go up on that day. I can sell a put, buy a call, whatever. And what happens is it's a cash settlement, and I can do it all over again tomorrow. So essentially, you get that shot of dopamine every single day.
It's a fantastic shot of dopamine. And as Ed mentioned, these are cash-settled instruments, and so you end up with a situation in which it almost never existed. It just seems like either cash in your pocket or a bet. And I would actually take issue with Ed's expression of the use of the word opinion. These are actually bets that are being placed in the market with cash for a relatively random event. Does the market go up or down on any given day?
Yeah, so does anything concern you about this? I mean, you and I have talked about this before. Options trading is growing, partly because there are more options trades that are available. Ed's done a brilliant job of expanding the business of options trading over the many, many years to his credit. But is there any worries about this?
Well, there have to be worries about anything new that you introduce to the market. So when you create a new product like a 0 day to expiry option, we have to be thoughtful about how that's going to impact market trading behavior, market structure, et cetera. That type of dynamic where we're actually looking at the S&P 500 single day options, we're actually seeing an extraordinary amount of trading volume in the underlying instruments that is driven by these options at this point. That's my source of concern. That we've created conditions under which we could overwhelm the system under certain conditions.
Yeah, Ed, how do you respond to that? I mean, you understand some of these concerns about long-term the option tail wagging the dog at this point. Well, how do you respond to these concerns?
Yeah, I would say I would look actually take another level deeper in the statistics of what's trading, and we see open and close all day long. So this is not open necessarily at the opening bell and waiting until the end of the day to see whether or not the position that you've taken is paid off or not. This is intraday trade, buying and selling all day long, to be clear. So this is not amassing a great amount of open interest and seeing what happens at the end of the day. That is not what we're seeing here. And then further, if we look at the statistics, this is not one single strategy. This is not strike specific. What I mean by that is not everyone is piling into the same strategy. Quite the opposite. We see a great distribution among strikes in any given day. So there's not a concentration of opinion. And then the nature of the trade, the majority of them are risk limited, meaning it's open long call, or open long put, or a credit spread that is buying one option and selling another. So we see really limited risk at the end of the day on how these trades are being entered.
Michael, I would imagine, and I want to go back to this, but I imagine all of this trading activity is striking is taking notice, being taken notice by the ETF community, right? That, I mean, they must be salivating around it. You run an ETF that uses options.
Yep.
Tell us what the ETF community is considering around.
So what I tell you about the ETF community is we're primarily interested in selling these options because they are so profitable to sell. And so the strategies around buying the options, which are primarily those that are pursued by retail. So Ed correctly pointed out that a lot of these are buy to open coming from retail accounts. On the institutional side, we know that 85% of options are going to expire worthless on any given day. That creates conditions under which we want to sell them. We want to actually create a very high return and very consistent payoff associated with it. Traditionally, we've been focused on 1 month options or quarterly options. We've moved into the weekly options. Now people are beginning to explore the idea of selling daily, because if you have something that has a high probability of success, you want to do it as frequently as possible.
So does going to a daily option increase, does going to a daily option pose any risk to the stability of the underlying stocks or to the markets in general? Is there any risk that, sorry to use this again, but the option tail could wag the equities dog here?
Well, so as Ed pointed out, these are tightly, there's a lot of different strikes, but those strikes are very tightly distributed. Very few people are entering into a 1 day or a 0 day to expiry option that's 5% or 10% out of the money. Almost all of these are happening within 1 to 2% of the what we call at the money strike, the spot strike. When that occurs, the actual process of making a market in these options leads the market makers to suppress volatility. So they're constantly trying to make as many of them expire worthless as they possibly can, managing their exposures. The problem is if something happens that drives us out of that range on a 1 day basis. We saw this in November of 2022 when there was a CPI surprise and the market rallied 5% almost instantaneously. That was actually people chasing what's called the gamma, a phrase people have probably heard associated with meme stocks. Now that's happening with the S&P.
How about that, Ed? I just want to go back to Michael's point here. Michael has said that while it's not clear what the impact of higher levels of options trading could be, I think he makes a valid point. Years ago, there were only quarterly options, then we had 1 month options, now we have 1 week options, now 1 day, essentially. And his point, I think, is that this increases the impact of the options on the underlying securities. Is there a point to this, do you think?
There would be, and I think the other comment I think is a little bit off, is market makers can't make an option trade out of the money or expire worthless. That's impossible. We're talking about the U.S. benchmark here. This is not a simple a low market cap meme stock, for example. This is the U.S. market. So a market maker having the ability to make something expire worthless doesn't make a whole lot of statistical sense to me. And then I'd also say I'd look at the open and close and the nature in which market makers, professionals like the group standing behind me, are hedging. They are not necessarily running over to the futures market and trading underlying futures. They're trading option to option in favor of those options that expire similar time frame as the opening transaction. So for example, if a sophisticated retail customer is buying an option, a market maker would look to another option as their hedge and not necessarily run to the futures market. So a little bit different when we're talking about the nature of the cash settlement here, and then the exposure, and then the overall breadth of the market.
You don't have a problem with sophisticated, hedge fund people or market makers hedging their bets on the say. Let's just take Apple. Let's use a real example. It's Apple's, they're going to be reporting earnings, and that day, market makers want to hedge their bets, and you can use this to hedge your bets.
Absolutely.
But you have a different concern about, retail people just getting in thinking they're going to make one-way bets.
So I think there's two separate components. One is we use the phrase sophisticated retail investors, and I think there's actually a really important distinction there, because in general, those who are buying options on a consistent basis are doing more speculation than they actually are being sophisticated in terms of a return profile. It tends to be a losing bet. The second component is what Ed was referring to in terms of the market makers themselves trading the options. We absolutely see that. Actually, there's a suspiciously high number of these options that are settled at what's called the mid. the difference between the bid and the ask, suggesting that the dealers are trading them amongst themselves, hedging exactly as Ed is highlighting. The challenge that emerges is when things don't function normally. Yeah. Because if you move outside of that range, the options no longer exist, and then they need to hit the futures market.
Well, let's try a real-world example. Let's pick Apple instead of the S&P 500.
Sure.
You could trade Apple zero date expiration. Suppose you have a big move in Apple. Pick a number, 2%, something a little outside normal, and there's significant trading in the significant positions in that zero-day option. How could that affect the underlying stock or the volume that's traded?
So on individual stocks, we're still at the point where the single day expiry is only available in certain situations. They're not available every single day, although that is an area that is being moved to introduce. But to answer your question very specifically, if we're approaching an option expiry, so we're at 0 day to expiry, and Apple were to move 2%, the quantity of shares that need to be traded because of what's called the gamma, the change in the hedge ratio that the option maker would use, is explosive. So on a 2% move in Apple, you'd see something like 23 shares traded on a 0 day option. On a 2% move, if I were in a 3-month option, we'd be talking a single share. So the potential for these types of options to magnify the impact of moves is becoming larger and larger.
Just on volume, if you have a 2%, again, I'm just picking this 2% number. 2%, Apple moves 2%. Would just the trading around those 0 date expiration options have a significant effect on the volume in general? I'm not even asking about the price.
Absolutely. So this is part of what we see when we see option expiry days, is we see an explosion in volume in the underlying securities themselves. Our estimates suggest that you could see up to 20% of the volume in Apple itself being driven by that type of 2% move causing option hedging activity.
Yeah. You know, I think you're getting my point here. It's perfectly legitimate to have professional market makers seek ways to hedge their exposure. I don't think that's an issue at all. I think what people are looking at is what happened, for example, when the volatility exploded, when Volmageddon, remember that a few years ago, and all of a sudden unforeseen circumstances happened here. This is just getting bigger and bigger all of the time, and that, I think, is the issue that we're dealing with.
The great irony to you introducing Volmageddon was actually I was involved with that trade on that day, and it predicted in advance that that product would go to 0 on a 4% decline in the S&P, which seemed crazy when it was made a year before that. But the reason why was precisely what you're highlighting, Bob. It's when things happen that aren't expected. And when we create products like this, things that have happened in the past have a different impact.
So again, this question is who's doing the trading here? Retail traders are obviously very significant, and market makers are, involved making a market on the other side because retail traders are involved. So it's hard to sort the threads out on this. Is it your impression that most of this trading still is done on a retail level? Who's initiating these trades on the last day of trading?
So on the initiation, we would suggest, on the actual initiation process, we'd suggest about 1/3 of the trades are coming from retail and about 2/3 are coming from institutional. The retail is biased to buy, the institutional is biased to sell. In between those two, as Ed was pointing out, there's all sorts of market maker activity, and they actually represent the vast majority of it because, exactly as he's saying, they're trying to open and close their positions by canceling them out with equivalent options.
Ed, how significant, I don't think we put up much data, but I want to let people know how significant this has become. What portion of, say, trading activity in S&P options is 0 days to expiration? How big is it now? Can you give us a number?
About 40%, about 1.2, 1.25 million contracts a day. But as I point out earlier, this is not just opening a position at the beginning of the day. This is trading in and out all day long. And so we don't have this monster amassed open interest at the end of the day. This is really a lot of two-way flow. But my retail numbers are slightly lower than Michael. It's probably closer to 25 that we see, but nonetheless, it is a growing retail interest.
But 40%, that's an astonishingly successful product for one that essentially, even though obviously options expired on the day for, since they started in the 70s, but this is an explosively successful product. It's really amazing.
Particularly when you consider in that denominator is actually the option volume of these themselves, right? So they have driven the option market, and we're actually seeing volume at the traditional reference points, things like the VIX, the 30-day, we're seeing that fall. So it's not that option activity overall is growing, it's these options.
Yeah. Ed, I want to
we've actually had growth in Third Friday as well. Yeah.
You can say that again, Ed? I'm sorry.
He's disagreeing
We've actually
with my analysis.
Yes, we've seen year-over-year growth in third party as well. This has just been so incredibly fast growing that this is gaining all the interest.
But I want to point out to the viewers that this is not happening organically. It's happening largely because Cboe has successfully introduced new products. You had 5-day contracts on 3 days of the week, and now you have them on 5. And is that not? That didn't happen a couple of years ago. That your new products is a major reason we're getting this successfully.
Oh,
so,
yeah, no, I totally agree with that.
Go ahead, Ed.
It was a year ago in May. You're exactly right.
Okay.
So in that time period, I mean, one of the things that we've seen, you talked about the idea of institutional investors using it to hedge. Let's say I'm worried about a Federal Reserve meeting. A single-day option gives me the opportunity to protect my portfolio against equity exposure on that day.
Yeah, and again, the beauty of it, that dopamine shot, it's one day. You're making a bet on one day and you're closing out. You're not worried about what's going to happen a week, 2 weeks, a month.
Or it's removing the dopamine by allowing me to sleep at night with my investors' money, right? So that's actually a very interesting component. The thing that's so interesting, Bob, is if we go back to last November or we go back to last September when these products began to be introduced, we would see levels of implied volatility around things like Fed days explode. Yeah. But what's actually happened is the institutional industry, the institutional investors have figured out the joke on these, and they sell them relentlessly. So now we're seeing Fed days emerge with no noticeable increase in what's called the implied volatility or the price that's priced into that move.
Yeah. Ed, I want to just hit you on another subject while I've got you here. Cboe has several applications for Bitcoin ETFs to list on Cboe. I know you're handling Wisdom Tree, Van Eck, ARK as well. Could you handicap for us the chances the SEC will approve these applications this time? A lot of people seem to think this surveillance sharing agreement with the exchanges that you've announced, I think NASDAQ has announced it as well with BlackRock, is certainly going to make a big difference. Will it make a difference, and what are the chances? Everybody's been waiting for years and years for this one.
I've been wrong for years and years, but what we are committed to, and not surprising, like Michael's business, the more transparency we can give our regulators. Their main concern is the average investor and their safety and security. And running these transparent and open and markets where that is key to success, we'll keep giving more information to our regulators. We want them to have every bit of information that we have at our fingertips so that the surveillance and the confidence for all investors is top notch. So we'll keep providing more information. This is maybe a step closer, but very, very difficult to handicap what's going to come out of a regulator.
Well, the community seems very excited. The community has been wrongly excited in the past, but it does seem to address a portion of their concerns. What I'm not sure is whether it addresses all of their concerns. I think they're going to go fighting, rather significantly. Did you follow this Ripple ruling last week where a court essentially gave partial clearance to the idea, or partial okay to the idea that a Bitcoin ETF might be approved this time? I mean, you have to read between the lines. It wasn't a clear victory for the crypto community, but it was a partial victory. Does that matter at all in their thinking, do you think?
I'd be interested to hear Michael's view. For us, it's just more clarity on distinction and what it is actually that we're trading, what the underlying that we may be trading, what the exposure is, but doesn't give me a whole lot more confidence in an approval that would be imminent. As I say, more and more information, more and more clarity from the SEC. We'll continue to provide that information, but I don't know that I would change my handicap a whole lot.
You have any thoughts on this?
Yeah, I mean, this is an interesting situation in which the SEC has effectively ruled that the institutional investors who had full disclosure and awareness were offered an investment contract. But
that's a security.
That's a security.
Okay,
But the exact same thing sold in the secondary market to retail investors has been deemed not a security. Right?
Does that make sense to you?
It makes no sense.
Yeah, under the grounds that what? Well, they're buying it on an exchange, and therefore they don't know they're supporting Ripple.
They do not understand that. That's absurd.
Was that?
No, I just think it's a bad ruling, but we'll ultimately see how that plays out.
Yeah,
I agree with
another.
I agree with
Seriously.
Ed that the entire space is struggling for clarity.
Yeah, okay. I'm going to leave it there. Obviously, we didn't come to any conclusions, but the whole community is excited about this. The crypto community is, at least. That does it for this week's ETF Edge. My thanks to Ed and Michael. We've asked Michael to stick around and chat about other upcoming ETF products. He's very involved in this for our ETF Edge podcast. Remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge.